you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Alan Dobbie, manager of the Rathbones Blue Chip Income and Growth Fund. Hello Alan.
Hi Emma.
So we're here today to talk about your fund. It has the word growth in it, which implies that you're looking for sort of good value stocks. How difficult is that considering developed markets have rallied so spectacularly over the last 5-6 years?
Well, markets have rallied very strongly over the last few years. We've seen a number of equity indices hitting new highs. But of course, what's important is not so much the level of the index, it's how that relates to the fundamentals, the earnings power, the cash flow generated by the constituent companies. So in terms of valuation, we tend to look at absolute valuation, relative valuation, and also sentiment. On absolute valuation, I think it's quite difficult to get too bullish from where we are at the moment. You know, if you look at something like the cyclically adjusted PE ratio in the US, so looking at prices compared to average 10-year earnings. Markets have only been more expensive back in the 1920s and the late 1990s. So I think it's quite difficult to be bullish in absolute terms. In relative terms, it tells the entirely opposite story. You know, equities have never been cheaper relative to bonds. So there's very mixed messages there. Also in sentiment, it would be hard to say that markets or investors have become euphoric, that you'd normally associate with markets hitting new highs. But there's a US value investor, Howard Marks. He's got this phrase that although investors may not be thinking bullish, they are acting bullish. You know, we've seen central banks pushing bond yields lower. They're forcing investors further up the yield curve, taking on more risk. So I think it's quite mixed messages on valuation. Finding value is getting harder, I would say, but we are still seeing interesting opportunities out there.
And looking at the other half of your mandate, because it is income and growth, that's quite unusual to find together. How do you marry the two? Does one prioritise over the other?
Well, there is always the risk that, with quite a broad mandate, that you try and be all things to all people. So the way that we manage to deal with that in our fund is we set ourselves a series of objectives, but they are, quite importantly, they're sequential objectives. Our first objective would always be capital preservation. We recognise that investors are putting a lot of trust in us by giving us their money, so our first rule is always don't lose the investors' money. After we're confident that we've achieved that objective, then we start thinking about income generation. We pay quite an attractive dividend yield. It's about 3.6% at the moment. Not as attractive as it has been relative to history, but then relative to bonds, it's looking pretty good. Once we're happy with that objective, that we've satisfied that, then we start thinking about income growth. We've got a good track record of income growth in our fund. And then once we've done all that, then we finally start thinking about capital growth. So it's really a series of objectives that we have to think about.
You mentioned there that the first priority is capital preservation. Does that mean in a market like this, you're just not considering certain sectors, either because they've become quite expensive or because the macro backdrop, for example, oil stocks, is just not supportive to the concept of capital preservation?
Yeah, we're not worried about any kind of benchmark risk or anything in our fund. It's a very concentrated fund. We only own 30 stocks. We're quite happy to zero weight a sector. We currently don't own anything in banks. We are quite wary of oil stocks. We're very underweight the sector. We're concerned about dividends, actually, in some of the big oil majors. They're not generally covered by free cash flow, which would be our first metric that we look at when looking at dividend sustainability. So they are some sectors we're worried about.
Alan, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.